Friends, welcome to Yadna Investment Academy. Ever heard about the term deflation? I'm sure you must have heard about the term inflation. So, what exactly is deflation then? Deflation is the exact opposite of inflation. Now, in inflation, there's steady increase in the prices of goods and services, whereas in deflation, there's steady decrease in the prices of goods and services. So, what is the cause of this deflation? Now, be it inflation or deflation, both depend upon the demand and supply equation. Like in inflation, more money is chasing fewer goods and services. That is, there are fewer goods and services available in the market, and you're ready to pay more price. And that is what increases the general price of goods and services. Whereas in case of deflation, there's an excess supply or production of goods and services, and so it is available at a cheaper cost. So less money is chasing more number of goods and services available in the market. So a major shift in this demand and supply equation is what causes deflation. Now we have heard more about inflation and less about deflation because our country has been always battling with inflation. And so we are scared about the term inflation. But inflation is not really bad. It's rather good for an economy. When you understand what impact deflation can cause on an economy of a country, you'd start realizing that inflation is rather good. So let's see how. So what is the impact of this deflation? Now in case of deflation in an economy, the consumers might take advantage of their buying power and would spend more as goods are available at a cheaper cost. But however, they would later realize that the prices would continue to drop further and this would dampen their spending itself. As there is decrease in consumer spending, there would be drop in demand of goods and services, due to which the companies would be forced to cut prices to clear their inventory. This would result into drop in business revenue. Now once there is drop in business revenue, the businesses would want to control their costs. They would do this by reducing wages and by doing layoffs. In case of reduced wages, people might not be able to service their loans. Let's say, for example, a home loan. So, in case of defaults, the bank might try to seize your property and try to foreclose the loan. But there's already drop in demand for houses as well. So, bank may not be able to foreclose this loan, which turns it into a bad loan. And fearing further bad loans, the banks might slow down the lending itself, which further dampens the consumer demand. As there is drop in business revenue, this will impact the share prices of the company in the stock market. And so the investors wouldn't invest into the stock market due to this drop in the share price. So people would turn towards fixed income securities like fixed deposits. But now due to drop in demand, the central bank, that's the RBI, would try to boost the demand by pumping in more money in the system. But now, as more money is pumped into the system, this would reduce the interest rates as well. So now, people would have no other option but to hold on to cash. And all this would in turn again decrease consumer spending. So this is how deflation impacts the entire economy, wherever consumer spending comes into the picture. For example, it would impact housing, which would in turn impact banking, etc. Whereas exact opposite happens in case of inflation. In case of inflation, there is increase in consumer spending, that is rising demand. Due to rising demand, there is rise in business revenue, where the businesses want to do profit sharing by increasing the wages and by offering more jobs. This in turn boosts lending. Due to rise in business revenue, there would be rise in share prices of the companies in the stock market. So people would now want to invest into the stock market. Due to rising demand, the central bank, that's the RBI, would want to tighten in money supply by increasing the policy rates. Now due to less money available in the market, the interest rates would also increase. And all of this would in turn increase consumer spending. And this is how inflation is beneficial to an economy. Japan is facing deflation since 1990s due to tight monetary conditions, unfavorable demographics and bad loans. Similarly, there are other European countries like Bulgaria, Greece, Sweden, Poland, Spain which are facing deflation. So why should you know about all this deflation? The fear of deflation lowers investor confidence, which in turn is reflected in markets across the globe, and that's why we should know about it. So, how do you know whether your country is facing deflation? Consumer Price Index can help us here. Consumer Price Index measures the actual change in retail prices. The new CPI adopted by India in 2011 has around 250 components against just 25 components in the older CPI. So if a CPI has gone down, you know it is deflation, and an increasing CPI indicates inflation. So can deflation also be good? In case of electronic items, the kind of reduction in prices we have seen in case of mobile phones, laptops, etc. in the last decade is not due to change in demand and supply equation, but it is due to innovation. And this kind of deflation is definitely good. So friends, that's all on this video. Hope the video has given you a fair idea of what deflation is. Thanks for watching this one. Watch this space for more such topics. If you have any questions, do let us know in the comment section below our videos. And if you like our videos, please do subscribe and share. Before we end, we want to let you know that Yadnya Investment Academy's first book, which is a collection of 108 questions and answers on mutual funds and SIP, is available on Amazon, Flipkart, etc. And the link to buy the same is mentioned in the description of this video. So see you in another video. Until then, happy investing.